Did you know that UK house prices are now more than 8 times the average salary, the highest affordability gap in over 150 years? And yet, thousands of new homes are sitting unsold. Something doesn't add up. Interest rates have more than quadrupled in just 2 years. Mortgage payments are skyrocketing. Landlords are jumping ship, and millions of homeowners about to face a financial cliff when their fixed deals expire. So, is the UK housing market about to crash? In this video, we're uncovering 10 shocking reasons why the property market might be heading for a serious collapse and why almost no one is talking about it honestly. If you're thinking of buying, selling, or even just renting, this is something you can't afford to ignore. Stick around because what you hear in the next few minutes might completely change how you think about property in the UK. Number 10. Market psychology: fear replaces FOMO not long ago. The UK housing market was driven by one powerful emotion: FOMO, fear of missing out. Buyers were rushing in. Bidding wars were common, and people were stretching their finances just to get on the ladder before prices rose again. But now, that emotional fuel has completely flipped. The new dominant emotion? Fear. Not fear of missing out, but fear of overpaying. With house prices stalling or dropping in some areas, rising mortgage rates, and increasing talk of a crash, buyers are holding back. Many are waiting, watching, and asking, what if I buy now, and the value drops by £50,000 next year? This shift in mindset is incredibly powerful. Housing markets are heavily driven by emotion and confidence. When people believe prices will rise, they buy fast. But when doubt creeps in, activity slows, and prices often follow. We're already seeing this ripple effect. More homes sitting on the market longer, more price reductions, fewer first-time buyers making offers, even social media is playing a role. Reddit threads, TikToks, and YouTube channels are full of warnings about waiting for a crash. And whether those predictions are accurate or not, they're changing behavior. This change in psychology might be one of the biggest drivers of the next market shift, and it's happening quietly under the surface. Quick question for you: do you think the market is cooling, or is this just a pause before another boom? Drop your thoughts in the comments below. And if you're into real talk about money, housing, and what's really going on behind the scenes, hit that subscribe button. There's a lot more coming your way. Number 9. Changing buyer mindsets for decades. Owning a home in the UK was more than just a financial decision. It was a status symbol, a life milestone, a marker of success. It wasn't just encouraged, it was expected. But that mindset, it's changing fast. Younger generations, especially millennials and Gen Z, are approaching homeownership with a very different lens. For many, it's no longer seen as a must-do life goal. In fact, some actively question whether it's even worth it anymore. Why? It's because when the average deposit in many cities is over £50,000 and mortgages eat up half your monthly income, the dream begins to feel more like a trap. Add in job insecurity, rising living costs, and a growing culture of mobility, and you have a generation that's redefining what financial success looks like. Instead of owning, many are choosing to rent long-term, invest in experiences, or build flexibility into their lives. They value freedom over a fixed address. And here's the kicker: this shift in mindset isn't just emotional, it's starting to reshape market behavior. Demand patterns are changing. Certain types of properties are losing appeal. The old assumption that property always goes up is being questioned by a generation that's never really seen stable affordability. So while economic indicators matter, cultural shifts like this one can be just as powerful. When fewer people even want to buy, demand doesn't just slow, transforms. And that transformation? It could be one of the clearest signs that the housing market isn't just under pressure, it may be entering a new era entirely. Number 8. Over-reliance on foreign investment for years. Foreign investment has acted like a turbo boost for the UK property market, especially in major cities like London, Manchester, and Birmingham. Overseas buyers, particularly from China, the Middle East, and parts of Southeast Asia, poured billions into UK real estate. often snapping up luxury flats before they were even built. In many cases, these properties weren't bought to live in, but to park wealth. Safe, secure, inflation-resistant. A second passport in the form of bricks and mortar. But now, that flow of foreign capital is slowing and the market is starting to feel the pressure. Stricter capital controls in countries like China, currency fluctuations, and global economic instability have made international investors more cautious. Some governments have introduced policies to prevent money from leaving their countries so easily, while others are discouraging speculative property buying abroad. The result? Entire developments that once sold out to foreign investors are now struggling to fill units. Ghost towers, half-empty buildings, beautiful showrooms, and no one living there. This trend has two major effects. First, it removes a major source of upward pressure on prices. And second, it leaves developers exposed they've built based on expected demand that no longer exists. What's even more concerning is how much of the high-end housing market was dependent on this foreign demand. When a market leans too heavily on outside money, it becomes fragile. If those investors vanish or even hesitate, the entire pricing structure can start to wobble. And right now, that wobble is already underway. Number 7. Wage stagnation versus inflation. One of the most overlooked but powerful forces behind the housing market's current instability is the growing gap between wages and the real cost of living. Over the past decade, wages in the UK have remained largely stagnant, barely keeping up with inflation, and in many cases, falling behind. But while paychecks have flatlined, essential living costs have soared. Energy bills, groceries, transport, childcare, everything has become noticeably more expensive. And now, with interest rates rising, mortgage payments are joining that list too. For many would-be buyers, this creates a painful squeeze. Even if they technically earn enough on paper, their disposable income has shrunk. Like saving for a deposit. It feels nearly impossible. Getting approved for a mortgage is harder, and for those who already own a home, renewing a mortgage at today's rates can mean a huge spike in monthly repayments, sometimes hundreds of pounds more per month. With no matching increase in income to soften the blow, this disconnect between earnings and expenses is eroding consumer confidence, especially among first-time buyers and lower-income households. People are less willing to take on long-term financial risks when they're already struggling to make ends meet day to day. And if buyers can't afford to buy, sellers are forced to lower prices or wait indefinitely. The housing market doesn't just rely on property values going up. It relies on people believing they can afford them. Right now, for a growing number of people, that belief is slipping away. Until wages catch up with reality or prices fall back in line, this imbalance will continue to weigh heavily on the market's stability. Number 6. Government schemes running out of steam for years. Government schemes like Help to Buy, stamp duty holidays, and shared ownership programs acted as fuel for the UK housing market. These initiatives were designed to make homeownership more accessible, particularly for first-time buyers, but they also had a powerful side effect, and they artificially inflated demand. With lower upfront costs and financial support, more people could jump into the market, pushing prices up and feeding the illusion of unstoppable growth. But here's the problem. Many of those schemes have now ended, or are being phased out, and the housing market is beginning to feel the effects. Help to Buy officially closed 2 new applications and the stamp duty holiday, which created a frenzy during the pandemic, has long since expired. Without those safety nets and incentives, buyers are suddenly being exposed to the true cost of homeownership, and for many, it's simply too high. What's left behind is a market that became dependent on these schemes to keep moving. With them gone, demand is softening, especially among younger buyers who were already struggling to save deposits or qualify for mortgages. Developers are also feeling the pinch. Many of them built with the assumption that government support would keep buyer pipelines full. Now, with fewer qualified buyers and reduced demand, unsold properties are starting to pile up. It's like pulling the plug on a machine that's been running on borrowed power. The momentum doesn't stop instantly, but the slowdown is clear. These schemes may have been introduced to help people, but they also propped up prices in an unsustainable way. Now that the support is gone, we're beginning to see what the housing market looks like when it has to stand on its own, and it's looking shaky. Number 5. Buy-to-let exodus 4 years. Buy-to-let was seen as a solid investment strategy in the UK. Steady rental income, rising property values, and tax benefits made it a go-to for many investors. But today, that landscape has shifted dramatically, and landlords are beginning to head for the exits in growing numbers. The reasons? It's a perfect storm. Rising mortgage rates have turned once profitable rental properties into financial burdens. Landlords who've secured cheap loans, just a few years ago, are now facing huge increases in repayments as fixed deals expire. For many, the maths no longer adds up, especially with tightened tax rules that have slashed mortgage interest relief and added new charges like the additional 3% stamp duty on second homes. On top of that, new regulations such as stricter energy efficiency requirements and increased tenant protections have added extra costs and responsibilities. While these changes aim to improve housing standards, they've also made it more expensive and complex to be a landlord. As a result, a growing number of landlords are choosing to sell their properties, cash out while they still can, and exit the market entirely. This trend isn't just a one-off, it's building momentum. And as more rental properties are listed for sale, it increases housing supply, puts downward pressure on prices, and reduces competition in the buyer's market. But it's not just about sales. The exodus also has knock-on effects for renters, as some landlords hike rents to cover rising costs, while others sell up and reduce available rental stock. Either way, it's a signal that the buy-to-let model, once a pillar of the UK housing system, is starting to crack under pressure. That shift could reshape the entire market in the months to come. Number 4. Rising supply. Shrinking demand. One of the clearest warning signs of a struggling housing market is when more homes are listed for sale, but fewer people are buying, and that's exactly what we're starting to see across parts of the UK over the last year. Property listings have been on the rise. More sellers, especially landlords and overstretched homeowners, are putting their homes on the market, either to downsize, reduce debt, or simply exit while they still can. At the same time, new build developments continue to add supply to areas that were already saturated. In isolation, this might seem like good news. More choice for buyers, right? But here's the catch. Demand is dropping at the same time. Higher interest rates, tighter lending criteria, and falling consumer confidence have made buyers more cautious than ever. Many are sitting on the sidelines waiting for prices to fall further before making a move. Mortgage approvals are down, viewings are slower, and properties are sitting on the market for longer than they used to. This mismatch between supply and demand creates pressure on prices. Sellers are being forced to cut asking prices to attract interest. In some areas, price reductions have become the norm rather than the exception. And with fewer bidding wars and more negotiating power on the buyer's side, the momentum that once pushed prices upward is now starting to work in reverse. The more this trend continues, the more it feeds itself. Falling demand discourages new buyers. More supply builds up. And slowly but surely, we move from a seller's market to a buyer's market, a key stage in what many experts see as the lead-up to a broader housing correction or even a crash. Number 3. Mortgage time bomb. There. It's a ticking clock hidden in the UK housing market, and it's about to go off for millions of homeowners. It's what experts are calling the mortgage time bomb. Here's what's happening. During the era of ultra-low interest rates, millions of buyers locked into 2 5-year fixed-rate mortgage deals, often at rates below 2%. That made monthly payments feel manageable, even for expensive homes. But now, as those fixed terms come to an end, ain't many homeowners are being thrust into a completely different financial reality. Rates have risen sharply, and those once affordable mortgages are now being renewed at twice or even triple the previous rates. For some households, this means their monthly repayments are jumping by hundreds of pounds overnight, with no increase in income to cushion the blow. It's a sudden, painful shock to the system. The worst part. This wave of expiring mortgage deals is only just beginning. In the next 12 to 18 months, more than 1 million homeowners are due to remortgage, many of whom are unprepared for what's coming. Some may scrape by. Others will face difficult choices. Cut back on essentials, dip into savings, or worse, fall into arrears or consider selling. This ticking time bomb has the potential to unleash a domino effect across the housing market. If enough homeowners start to default or panic sell to avoid repossession, we could see a sudden increase in supply and a sharp drop in prices. It's not just theory. We've seen similar patterns play out in other countries during financial downturns. And unless rates drop quickly, which seems unlikely, this wave of remortgaging could be one of the most significant triggers of a market-wide correction. Number 2. The interest rate reality check. For over a decade, the UK housing market thrived on ultra-low interest rates. Borrowing was cheap, mortgage deals were competitive, and many buyers stretched their budgets, assuming rates would stay low forever. But that era is over, and the adjustment has been nothing short of brutal. In 2021, the Bank of England base rate was just 0.1%. Fast forward to today, and it has risen above 5%. That may not sound dramatic at first glance, but in real terms, it's having a huge impact on what people can afford. A mortgage that once cost £800 a month might now demand £1,200 or more for the exact same property. For many households, this means less disposable income, more financial stress, and stricter mortgage approvals. Lenders are being more cautious. Affordability checks are tighter. Buyers who once qualified for a £300,000 mortgage may now only get £220,000, which either pushes them down market or out of the market entirely. This isn't just hurting new buyers. Homeowners looking to remortgage are facing massive jumps in repayments. Some are being priced out of their own homes, forced to sell or take on extra debt just to stay afloat. The knock-on effect is growing unease and declining confidence, too. Factors that heavily influence housing activity. What we're witnessing is a hard reality check. For years, the property market was supercharged by cheap borrowing. Now, with interest rates back to normal levels, the true cost of homeownership is being felt. And the market is struggling to keep pace with this new financial environment. This shift isn't temporary, it's structural. And it's forcing everyone, from first-time buyers to seasoned investors, to rethink their position in the market. Number 1. Unaffordable affordability. It sounds like a contradiction. But unaffordable affordability is the strange and frustrating reality of the UK housing market today. On paper, there are signs that prices are softening in some areas. Some sellers are dropping their asking prices. Builds are offering incentives. But despite all of that, for the average person, owning a home feels more out of reach than ever. Why? Because it's not just about the price of the property, it's about what you actually need to afford it. Over the past 2 decades, house prices have outpaced wage growth by a huge margin. The average UK home now costs over 8 times the average salary, and in some cities like London, it's closer to 12 times. That ratio makes saving for a deposit incredibly difficult, especially when paired with high rent, rising living costs, stagnant wages. Then add in the effects of higher interest rates. Even if the asking price is slightly lower, the monthly repayments are often much higher than they were just a couple of years ago. What looked affordable at a glance becomes unaffordable the moment you crunch the numbers. The result is a market where buyers are priced out, sellers can't get what they want, and many people are stuck, able to move up the ladder, get on it, or even downsize without financial strain. It creates a cycle of frustration with fewer transactions, longer wait times, and declining confidence. The housing market doesn't just need lower prices. It needs a total reset on what affordability really means. Till then, the illusion of affordability will continue to hide a far more difficult reality, a market that excludes the very people it's supposed to serve. So is the UK housing market heading for a collapse? The warning signs are hard to ignore, from rising interest rates and unaffordable mortgages to changing buyer mindsets and weakening demand. Whether you're a buyer, seller, landlord, or just watching from the sidelines, understanding these shifts puts you ahead of the curve. What do you think? Is this a slow correction or the calm before a crash? Drop your thoughts in the comments. We'd love to hear your take. Like this video if it gave you a new perspective. And subscribe for more honest, data-backed insights on the housing market.